Welcome back. Well, let's focus on another management. Maharashtra Seamless, the numbers looked a little bit weakish. Quarter three was a stellar set of numbers, so maybe that's what's playing on these results as well, because relatively these numbers were much weaker. The stock, however, has corrected more than 20% from the recent peak, telling you that the street was bracing for a rather weak set of numbers. Mr. Kaushal Bengani, the Deputy General Manager, joins us on the show. Hi, Kaushal. Good morning, and thanks a lot for joining in. Well, for the markets, we track two basic numbers. One is on the volume front and one is on the EBITDA per ton front. Could you tell us for both the verticals, what kind of volume growth are you looking at on the ERW as well as in the Seamless division? And what's the steady state EBITDA per ton we should look at? Because in this past quarter, this Seamless number did come down quite a lot.
Yes. Thank you for having me. In the fourth quarter, we had dispatches of close to 95,000 tons, and that is lower than what was there in the previous quarter of this year and also the quarter of FY23, last quarter of FY23. The primary reason why that happened in this particular quarter was because of mismatch in the product mix that we have. We had certain large size orders which were expected to be dispatched in this quarter, but that did not take place. Going forward, we expect that to normalize because we recently received a large order from ONGC of 674 crores and our order book remains good. Right now, our order book is 60% ONGC and Oil India, and generally these are good margin orders for us.
Okay. All right, Kaushal, so we got that. There was a dispatch that got pushed forward, which in turn resulted in a weakish showing in quarter four. But let's talk about FY25 then. For your Seamless division, last year, I think you did roughly around 400,000. For this year, what can you do on volumes? And on ERW as well, it was around 100,000. So on both these two, what can you do, given that your order book is looking quite good at around that 1,1800 crores?
In FY25, we'll probably do same levels for ERW, which is around 100,000 tons, maybe 5% growth, because we've recently been able to ramp up production on the ERW front. On the Seamless front, we've not been able to ramp up production immediately because there is a finishing line which we are trying to implement at our Telangana unit. Once that is in place, we will immediately see volume growth in the quarter in which it is implemented. As of now, we expect that to take place in the fourth quarter of FY25. But
please go ahead.
Okay. So on the volume growth front, I don't believe we'll have volume growth significantly in FY25, but definitely in FY26, because in FY25, we will be taking shutdown in one of our mills for preventive maintenance. That will have an impact on the quantity produced and dispatched,
so for
which may be negated.
Sure. For FY26, any indication of what the volume growth could resume to?
So FY26, once we have that finishing line in place, we'll have volume growth of at least 70 to 80,000 tons, because right now we are not utilizing that capacity fully on account of that bottleneck.
Okay. And out of your total order book, ONGC and Oil India is about 60% of the mix. So does this mean higher margins for you? Does this lead to higher margins?
Generally speaking, that is true. So we expect that to fructify in FY25.
Yeah. So what does that mean? I mean, if you have higher margins, right, coming in and you're expecting it to fructify from FY25, on the EBITDA per ton for both the segments, Seamless and ERW, what would a sustainable level be?
We wouldn't like to give you a number, but just to give you an estimate of what the range would be, in Q3, we did 30,000 rupees per ton on the Seamless front. And in Q4, we have done 21,000 rupees per ton. We expect margins to remain upwards of 15,000 rupees per ton going forward.
For Seamless,
for Seamless, which does not necessarily mean that there will be a decline, but because we have short cycle order books of 3 to 4 months, we are not able to comment on margins beyond that because I don't have that data with me.
And for ERW?
ERW would generally remain between 6,000 to 11,000 rupees per ton because the ERW segment is a mix of two sub-segments in which pipes are dispatched. There's an oil segment and there's a water segment. Depending on the margins that are generated in the oil segment and the water segment, the blended margin is received. So oil sector orders are more margin accretive than water sector orders.
All right, but Kaushal, I need to push you on this seamless guidance that you're giving us, more than 15,000. That will be very disappointing. Last entire year, you did 20 to 30,000 rupees. Why are you talking about this 15,000 rupees? Or is it just a base case scenario and it's likely to hover in that 20,000 odd range?
We are talking about a base case scenario because what we have seen is margins have continually gone up over the past 2 years from 12,000 rupees a ton to 31,000 rupees a ton. So
Okay.
because I don't have data for the rest of the year and we operate on a short cycle order book position, we would not want to give guidance more than 15,000 rupees per ton because that's the base case that we want to work upon.
Got it. Got it. Okay, rigs is a small part of your business. The EBITDA last year was around 50 crores, but there has been some repricing of rigs. So will it contribute much more for this year, or should we be working with a number closer to what you've done in the past? And also, since things are looking up, any plans of selling this rigs business?
Yes, on both the points, the rigs was repriced in May 2022. Unfortunately, the tender for the rig was submitted prior to the Russia-Ukraine war, which meant that the effect of the repricing was just missed. Because immediately after the Russia-Ukraine war in February 22, when new tenders were released, they went up as high as 80,000 rupees per day on the rig rental front. However, since the tender we had submitted was prior to the Russia-Ukraine war, when the rig was redeployed on a new contract in May 22, it was at 38,000 rupees per ton. EBITDA of 50 crores is what you should be projecting going forward because it's a 3-year contract which will conclude in May 2025.
Oh, okay. And any plans of selling it?
We do have a thought of taking the rig out from Maharashtra Seamless, but that is subject to board approval. So we've not yet started working upon it, but it's a thought which has been constantly been communicated to shareholders, and towards the end of the contract, we'll be looking at it.
Okay, all right. We will leave it at that. Thank you so much for joining in. We got lots of information from you. All the best for the quarter to come. That's Maharashtra Seamless. Their margins have expanded this time around, and but the stock, by the way, is under pressure, down almost 5.5%.